Hello, everyone. I'm Erol. Welcome to our documentary on taxes and how they affect your financial life. Let's begin with a simple question. What is a tax? A tax is money collected by governments from individuals and businesses. That money helps pay for services that society uses every day. Think about roads, public schools, police departments, fire protection, national defense, and many public programs that communities depend upon. Without taxes, governments would struggle to provide these services. The idea of taxation is not new. In fact, taxes have existed for thousands of years. Ancient civilizations collected taxes in the form of crops, livestock, labor, and eventually money. As societies grew larger, governments needed reliable ways to fund public projects and public services. Today, taxes remain one of the primary sources of government revenue. There are many different types of taxes: sales taxes, property taxes, payroll taxes, and income taxes. In this documentary, we will focus on income taxes. You'll learn why money is withheld from your paycheck, how federal and state income taxes work, what tax forms like the W-2 and 1099 mean, and how smart tax planning can help you keep more of your hard-earned income. Understanding taxes is an important part of becoming financially independent, and that's exactly where our journey begins. Now that we understand why taxes exist, let's examine one of the most important taxes most adults will ever pay: income tax. Income taxes are based on the money you earn. The more income you receive, the more income tax you may owe. In the United States, there are two major levels of income taxation: federal income tax, and in many states, state income tax. Federal income taxes are collected by the Internal Revenue Service, commonly known as the IRS. These taxes help fund national programs and government operations. State income taxes are collected by individual states. However, not every state has an income tax. For example, a Louisiana resident may pay both federal and state income taxes. A Texas resident pays federal income taxes, but Texas does not currently have a state income tax. When discussing income taxes, there are several important terms you must understand: gross income, adjusted gross income, and taxable income. Gross income is generally the total amount of money you earn. Taxable income is the amount that remains after certain adjustments and deductions are applied. And that taxable income is what governments use to determine your tax bill. One important fact surprises many people. The United States uses what is called a progressive tax system. That means higher levels of income are taxed at higher rates. But not all of your income is taxed at the highest rate. Only the portion that falls within a particular tax bracket. We'll explore exactly how tax brackets work in our next segment, because understanding tax brackets is one of the most important steps toward becoming financially literate. One of the biggest misconceptions about taxes involves tax brackets. Many people believe that moving into a higher tax bracket means all of their income is taxed at that higher rate. That is not true. The United States uses a progressive tax system. As income rises, different portions of income are taxed at different rates. Think of tax brackets as layers. The first layer is taxed at one rate. The next layer is taxed at a higher rate, and so on. Only the income within a particular bracket receives that bracket's tax rate. This system helps explain why a raise at work does not suddenly cause all of your income to be taxed at a higher percentage. There are also ways to reduce the amount of income subject to tax. These are called deductions. A deduction reduces your taxable income. Examples may include certain student loan interest payments or other qualifying deductions. Tax credits are different. A tax credit directly reduces the amount of tax you owe, dollar for dollar. For example, a $1,000 deduction reduces taxable income, but a $1,000 tax credit reduces your tax bill by $1,000. That is a major difference. Understanding tax brackets, deductions, and credits helps explain why two people with similar incomes may owe different amounts of tax. And it helps you make smarter financial decisions throughout your life. Imagine you have just started your first full-time job. You receive your first paycheck. You know your annual salary. You know how much you expected to earn. But when you look at your paycheck, the amount deposited into your bank account is much lower. What happened? The answer begins with understanding gross pay. Gross pay is the total amount you earn before any deductions are taken out. For hourly workers, gross pay is based on hours worked and hourly wage. For salaried employees, gross pay is based on annual salary divided across pay periods. But gross pay is not the amount you take home. Before you receive your money, several deductions are removed. Some deductions are mandatory: federal income taxes, state income taxes, Social Security taxes, and Medicare taxes. Other deductions may be voluntary: health insurance, dental insurance, retirement plan contributions, or other employee benefits. After all deductions are subtracted, the amount remaining is called net pay. Net pay is often called take-home pay. It is the money that actually reaches your bank account. For many young workers, this can be surprising. A paycheck may show $2,000 in gross pay, yet the actual deposit may be several $100s less. Each deduction serves a purpose. Taxes help fund government programs. Social Security and Medicare support public benefit systems. Retirement contributions help build future financial security. Understanding the difference between gross pay and net pay is essential, because your budget should always be based on what you actually receive, not what you earn before deductions. Not everyone earns income the same way, and that means not everyone receives the same tax forms. Two of the most important forms in the tax system are the W-2 and the 1099. The W-2 is used for employees. If you work for a company, your employer typically withholds taxes from each paycheck throughout the year. At tax time, the employer sends you a W-2. This form summarizes your earnings and the taxes that were withheld on your behalf. Many college students receive a W-2 from part-time jobs, retail stores, restaurants, banks, offices, and many other employers. The 1099 is different. It is commonly used for independent contractors and self-employed individuals. Freelancers, consultants, photographers, designers, and many gig economy workers often receive 1099 forms. Unlike employees, independent contractors usually do not have taxes automatically withheld. That means they are responsible for setting aside money for taxes themselves. This can create surprises for people who are unfamiliar with the system. Someone may receive a payment of $1,000 and assume the entire amount belongs to them, but a portion may eventually need to be paid in taxes. Some individuals receive both forms. For example, a person may work a traditional job during the week and operate a small side business on weekends. Understanding whether your income comes from a W-2 or a 1099 is important, because it affects how taxes are paid, how income is reported, and how you prepare for tax season. Every year, millions of Americans participate in a process known as filing a tax return. This is how individuals report their income to the government and determine whether they owe additional taxes or qualify for a refund. To complete a tax return, you first gather your tax documents. These may include W-2 forms from employers, 1099 forms from freelance work, and other documents that report income earned during the year. The most common federal tax form is Form 1040. This form summarizes your income, deductions, credits, and taxes already paid. The government then compares how much tax you actually owed to how much was already withheld or paid during the year. If too much tax was paid, you may receive a refund. If too little was paid, you may owe additional taxes. Many people mistakenly view a refund as free money. In reality, a refund often means you paid more tax than necessary throughout the year and are receiving the difference back. Most states that have income taxes also require a separate state tax return. As a result, many taxpayers complete both a federal return and a state return each year. Accuracy is important. Simple mistakes can delay refunds or create problems later. That is why taxpayers should carefully review their information and keep copies of important tax records. For most adults, filing taxes becomes an annual financial responsibility, and understanding the process makes tax season far less intimidating. Many people think about taxes only when filing a tax return, but financially successful individuals often think about taxes throughout the entire year. This is called tax planning. Tax planning is the process of organizing your financial activities in ways that legally reduce the amount of tax you owe. The goal is not to avoid taxes. The goal is to make informed financial decisions. One common strategy involves retirement accounts. Many employer-sponsored retirement plans allow contributions before taxes are calculated. As a result, taxable income may be reduced. At the same time, retirement savings begin to grow for the future. Tax credits can also play an important role. Students may qualify for education-related tax credits that directly reduce taxes owed. Certain deductions may also lower taxable income. Examples can include qualifying student loan interest payments or other eligible expenses. Another important part of tax planning is managing withholding. If too little tax is withheld from a paycheck, a large tax bill may result later. If too much is withheld, money that could have been used throughout the year remains unavailable until a refund is issued. Good record-keeping is equally important. Saving tax documents, keeping receipts when appropriate, and maintaining organized financial records can make tax season much easier. Tax planning is not just for wealthy individuals. It benefits students, young professionals, families, and retirees. The earlier you begin making tax-smart decisions, the greater the potential long-term benefit to your financial future. As we conclude our documentary, let's step back and look at the bigger picture. Taxes are not simply numbers on forms. They are part of everyday financial life. From your first paycheck to your first full-time job to major financial decisions later in life, taxes influence how much money you keep and how much money you spend. Today we learned why governments collect taxes. We explored how federal and state income taxes work. We examined tax brackets, deductions, and credits. We learned the difference between gross pay and net pay. We discussed W-2 employees and 1099 contractors. And we saw how tax planning can help individuals make smarter financial decisions. The good news is that you don't need to become a tax expert overnight. What matters is understanding the fundamentals. Read your paychecks, keep your financial records organized, review important tax documents carefully, and continue building your financial knowledge year after year. The students who develop these habits early often avoid costly mistakes later. Financial literacy is not about memorizing rules. It is about understanding how money works in the real world, and taxes are an important part of that world. The more you understand them, the more confident and prepared you become. Thank you for joining me for this documentary. I'm Erol. I appreciate you spending this time with me. Take care of yourselves, keep learning, and I'll see you in the next video.